No mic on. Hey everyone, welcome back. Hope you guys are having an awesome day. Happy Tuesday. Market is down just a little bit today, not as much as it was earlier today. Just a reminder, this is an opinion channel only about money. I don't offer financial advice, but I am here to talk about stocks, options specifically. I love trading options. It's one of my favorite things to do. We can talk about futures contracts. We can talk about brokerages, trades, whatever you guys like. I mean, this is my Tuesday chat. I do have a chat room, and that is on Discord. I get to interact with my patrons every single day, Monday through Friday, putting on trades, looking at trade ideas, trying to beat the market is as per usual. And the market has been up quite a bit. One of the things that I am looking at right now, oh boy, is that button not gonna work for me today? Oh, we're gonna have to go like this. Use something a little bit different. But looking at the market, we're looking at the S&P 500 right now. So this is SPY, and there is the ticker right there, SPY. We're looking at TradingView, and you can see how this recent run up, this is the one-day chart that we're looking at. So been quite the climb as of late, moving up as we have had not really great news. I mean, overall, oh, my buttons are not working today. That is no fun. When we're looking at the market the way that it is, the economy is not fantastic. I mean, there are a couple of stocks that are holding this up in general. If we take a look at some of the specific stocks, you'll see that most of the market is red today, but the big tech stocks are really kind of pushing the market up. And hey, Mike says, happy Tuesday from Massachusetts. And Alejandro is chiming in as well. Good to have you guys here. Thank you for letting me know where you're watching from. And if you've got specific stocks you want me to cover, I would love to hear your trade ideas or just the stock. Just type the ticker in the YouTube chat and I will get to those questions, because it's pretty fun to put these on. I've got IBKR loaded up. I'm ready to go with any options specific plays, because I like to use options to reduce my risk and increase the probability of making money on my trades. That's how I like to trade options. I know there's other people that trade options in different ways, but that's how I like to do it. Kevin, always good to see you. Thanks for saying hi. So let's get back into this. You're not going to see my face today very much because I'm going to stay on the screen, but we are going to look at a couple of different things as they come up. So there's the S&P 500. Let's take a look at the IBKR platform. If we look, the VIX right now is down a little bit today. It's trading at 14.09. And what that means is there's a 14% chance, a 14% likelihood, screwing that up. It means there's going to be a 14% move in the market up or down over the next year. That's what we are looking at when we see that VIX level of 14. The SPY is marking today at $437, down 1.86, down 0.42%. Now, earlier today, if we go into the 1 minute chart, we can see that I'm just going to go to 1 minute here. You'll see the SPY was actually down. I've marked this blue line as the open of the day, and the S&P 500 actually dropped quite a bit. This was after some earnings. This was after some numbers from the Fed against housing starts. So we were looking at a downward move in general, and now the market has been climbing back up. Where we're going to end today, not really sure. I mean, is this strength going to continue? I doubt it. But if we look specifically at some of these stocks, you can see that majority of the stocks on my list are actually down today. AA, which is Alcoa, down. You can see Apple is up. Amazon is up. Bitcoin up today at 5.89%. And then what else is up? We've got Dropbox up a little bit. CRM, Etsy marking at 95. HSBC, a little bit of strength in the banking sector as of late, which is nice. LVS, which is travel, Las Vegas Sands. Mara, which is Bitcoin related, obviously up 12% today. Oil down $70.76 a barrel, and Meta is up. So when you look at some of these big stocks and where the market is moving or what is holding up the S&P 500, it really comes down to the tech stocks. Microsoft is the only one of the big ones down today. I think Google's flat on the day. Oh, Google's down a little bit, 0.2%. So just looking at Google here in the center, if we look at the big ones, Apple, Amazon up, Google, Microsoft down a little bit. But that's really what's holding up this market right now, is some of the huge moves as of late in stocks like Apple. So if we were to take a look at the chart in Apple on the daily candles, you can see since December of this year, Apple has been on an incredible uptick. This is what is holding up the S&P 500 in general. So when we're taking a look at that, these larger components have moved up quite a bit. Microsoft, similar chart. If we clicked on that and we took a look, you would see that Microsoft is going to have a very, very similar move to the upside. Is this going to continue? It's really hard to say. I mean, the rest of the market is not doing all that well. Let's go back a little bit further and look at the weekly candles on Microsoft just to see, kind of put it into perspective when we look at a week's move. When we have these moving averages put on here, you can see that oftentimes these moving averages, there tends to be a little bit of a bounce. When we see a large drawdown and these levels get tested at those longer term 200-day moving averages, they offer support at these levels. When we're trading in this zone well above the recent moving averages, my assumption always is that there's going to be a little bit of a downslide here. Now, it doesn't mean that it can't continue. It just means that oftentimes when we've seen a large move up like this, they are followed by a move to the downside. And it doesn't always happen, but that is one of the ways that I like to trade in general. I'm going to try to click buttons here on my other switcher. Maybe that will make it a little bit easier for me. Got a couple of questions. Hey, Kevin, welcome. And hey, Kevin, thank you. I didn't respond to your email, but thank you for the Happy Father's Day email. Appreciate that very much. Mike, I've recently discovered the 112 trade and think it's fantastic. Sadly, it requires more buying power than I have. Do you have any alternatives that is a similar trap-like mechanic for smaller accounts? Absolutely do. So 112 trade is a bear puts. It's called a bear trap. Let's get this terminology correct. 112 is a bear trap. So what it is it has a short, sorry, not a short, but it's got a bear put spread in it, and then it has two naked puts on the downside. So it's all puts. Let me, rather than do this, let me talk about it in the brokerage. Let's set one up. Let's see if we can set something up on Microsoft. If we're looking at the daily candles on this, and we are thinking there might be a pullback, and we think, oh boy, we're going to try to make some money. I think that Microsoft might pull back into this 310, 290 area. So that might be a zone that I am looking at for putting on a trade. And how can I make some money off of this? Well, let's go to the option chain and take a look at it. So if we look here, if we go out, let's go out to July 21st, which is about 30 days out. And if I wanted to make money on that, the trade, typically a 112 would be something like this. So we're selling two of the 290 puts. That's the two portion. And we are selling one of the 310 puts, and then we're buying a 315 put. And the idea with this is that it gets opened for a credit. So you can see in IBKR, this shows as a negative value, which means that the contracts that I'm selling, these two 290 puts, I'm collecting 50 cents each, so about $1. Then I am selling one of the 310 puts, and I'm collecting about $1.35. So if collected between these two, $2.35. Well, I use most of that money to buy this 315 put. And what that does is it gives me, or this costs me $1.80 debit from the 235 that I'm collecting above. So I'm entering for a net credit of around 55 cents. So when we look at this profit profile, what you'll see is that there's no upside risk. I'm gonna drag this down a little bit so you guys can see this. So on this trade, if the market move or Microsoft continues to move up, then all the puts will expire worthless because they're all out of the money, and my net result will be whatever the opening credit was. Now, in this case, if I collected a credit of say $55 or 55 cents, then that would be the upside. If Microsoft continued to move up, I would just make $55 on this trade. If it moves down, however, I have this $5 wide bear put spread in it. So this spread itself is open for a debit, but it's financed by selling two of the 290s. Now, the problem with this one has a very interesting probability of profit of 100%. There's a very, very high likelihood of making money off this type of setup. But as Mike said, this is a very costly trade. The max loss is about $57,000. And for that reason, the brokerage holds quite a bit of money. If Microsoft does pull back, this trade could make $550, which would be a very, very nice return if it was to trade anywhere between $290 and $310. So the setup is quite good, but this might be too costly for some people. So this would be a margin impact of $14,000. And again, that's because the max loss on this trade is about $57,000. So what can we do? Well, the first thing we could do is we could add a long put to this. So if we purchased the long put at the 280, this would limit our loss on one of these contracts. We would still be able to open for a net credit, but this will significantly reduce our margin impact. Right here, the margin impact you saw is reduced completely. And if we look at this profit profile again, so I got to slide this down for you, you'll see that the max loss on this is now $29,000. So it's a half the max loss. Now, the credit is a little bit less as well. You know, the expectation is that I only am opening for a net credit of around $20. Boy, I wish I could make this work a little better. What can I do? What can I do to make this better? Didn't used to have this problem with IBKR, but the window in this view is all over the place. Maybe that's better that it's over it. So we are looking at opening this for a credit. In this case, it would only open for a credit of about $15 or so, maybe $16. When we hit submit order on this, what that's going to do, half that money is going to be given back in commissions. So the total estimated is about $14 credit if I was to be able to sell this to open today. So this is one way of reducing it. Now, there's another trade that you can do that's a variation of this, which significantly reduces this margin requirement and still keeps a pretty nice profit range. So let me just show you. What we can do is we can sell, or we can buy a second 280 put. Now we're looking very, very close. Now this one is open for a net debit, which is not what we want. It means if Microsoft goes up, then we actually lose money. Playing with this again, trying to get this working for you guys. So now you can see that this is a net debit. When we open the trade for a net debit, then the downside is that the downside of this trade is that we would lose money if the stock went up. So not a really great setup. But what we can do is we can increase the number of contracts. So right now, if you look at this, the max loss in this trade is about $1,500. Because of that, the margin impact is the 2,600 Canadian in this case, but considerably less. And if we just change this to 3 contracts for the downside credit put spread, we now have the ability to open this, hopefully for still a little net credit. And this trade is called a honey trap. So this is one of the variations. I use this quite a bit. It's something that's fairly new to me. You can see the $2,500 max risk on this. So $2,500 max risk, about $500 max profit. The problem with this is we have to open it for a credit. So we can do honey traps. This is the kind of typical where we do 3-3 for the lower put spread, the credit put spread, and we do 1-1 for the debit for the bearish put spread on the 310, 315. We could change this ratio a little bit as well. So you can change this to like a 4 and a 4. And what that will do is it will open this for a net credit, but you have increased the amount of risk. I've added another $1,000 worth of risk. I haven't increased the amount of profit. So we have to be careful what we're looking at when we're putting on trades like this. But the break even on this is about 288. So if we look at the chart, the Microsoft would have to be trading below this level right here in order for this trade to lose money. And it would make a $500 profit if the stock dropped down in between the 310 and 290 zone. So let me just draw that on there, 310, 390, and this is about a month out. So if it was to pull back into this zone, it would make $500. If it goes below that, obviously, if it goes below 280, then this is where the risk is. This is where I wouldn't want the stock to go. And that's into the zone below 280, which means I'm at a $3,500 loss in this case. So risking 3,500 to make 500 if the stock stays in here, and only 25 bucks if the stock stays above this 315 level. So that's the trade. That is called a honey trap. So we've got 3 credit put spreads on the downside, and then we have an embedded or a lower, but still out of the money debit put spread to open. If it's opened all for a credit, then that's the way we would want to set up that trade. They can be managed separately. You can manage the credit spread separately from the debit spread as well. But I definitely, in this environment, am looking at trades like that, just really watching my break evens. Todd Pepper, Levi, I hope you're enjoying your summer in the north. Can you please share your thoughts on working on a Tesla July short straddle, 230, 295? I don't mind owning the shares. Boy, Tesla has been on a run lately. So let's look at Tesla first off, because just last week during the stream, I was worried about a 217 position and being tested on a butterfly. One of our subscribers was watching. So looking at this now, looking at the 230, I mean, if I was willing to buy those shares, I mean, obviously I want to get in a good price, but there is potential that Tesla could continue to go up. Like, look at where the previous stock price is, 375. We have seen this stock trading at this before. And with this move, the way that Tesla moves, over here, if we look at the weekly candles, you can see up almost as high as 425 at some point. Now, is it going to move that far up? Don't know. But it is definitely something that we have to consider, is that there is potential to move up or down in this zone when we look back at the valuation. Tesla, obviously, one of those shares that is just trading higher this year. So let's look at the July shorts straddle, 230, 295. So just a quick little terminology thing, Todd. Generally, when we refer to a straddle, it means that the short put and the short call are the same. I know some software it does call them straddles when they're strangles, but I try to keep my terminology even across the board. So when I talk about straddles, I talk about short puts and short calls being at the same strike. When I talk about strangles or short strangle, then I have a short put and a short call at different strikes. So I'm going to refer to this trade as a strangle, just to keep the terminology the same from video to video for myself. So let's look at Tesla and let's look at this chain for July. So the July 21st, 31 days out, the 230 is a 16 delta short put. So I'm looking at the delta column here, and so that I really want this profit profile to jump in here nicely. So I'm looking at the deltas. That's one thing that I like to look at, 16 delta, and I've already looked at the chart as well. So now the other one was the 295. And this delta is 37, which means that this is this has a shorter delta. There's more risk to the upside than there is. It's skewed to one side. Part of the reason for this is because the trade has quite a bit of momentum right now, or Tesla has quite a bit of momentum. So 67% probability of profit. This is a very, very nice setup. Mechanically, I think that what I would be doing with this is I would be worried about a little more upside just because Tesla has been on such a run, and I would try to go a little more delta neutral. But this is the nice thing about trading in this way, is that we can choose to have whatever deltas we want. So in this case, this is short delta. This is actually betting against the stock in a slight way. So it's got 0.20 a delta. If we decided to go with a higher call, you could make this slightly delta neutral and still collect a very decent amount of money. And just by moving up to the 305, you can see this reduces the delta to negative 0.14. So we have we're basically leaning a little shorter, and that is because the long delta, the call has a higher delta value the closer we get to at the money. Now, I typically enter things pretty evenly because I like to not have a directional assumption. For me, when I'm looking at a stock, I think, well, there's about the same amount of chance that it could go up or down. If I was looking at a position and I was saying, well, I don't mind owning shares, the stock is up, I want to make some money to the downside, I'm looking for a little bit of short delta, and this is where I might consider setting up like a 111 trade or a 112 or that modified 112 that we just looked at. Then there's no upside risk, because I think that no matter what happens in this market, Tesla is going to move somewhere. So it's kind of nice to put on strangles because they're pretty easy to adjust. But at the same time, I would be taking a directional assumption in this case. So I would either adjust into my deltas with 30 days to go, knowing that I might be in this trade for a little while. I might decide to just start off delta neutral by going up. Let's just go see what the delta neutral trade is. In this case, I can collect $1,000 with a 77% probability of profit by having the short strangle here, 230, 335. So I have quite a bit wider profit zone. And then I would have a delta neutral trade or very, very close to it. Well, then what I could do is adjust as time went by. I might put on this trade today, and then in a couple days time, I can look at it again, look at the deltas and say, which way am I going to adjust it? I'm going to bring the call down, or I'm going to bring the put up and create a tighter strangle. And that's part of the reason why it's called a strangle, is because we get to kind of choke it in as time goes by. So I think that that's the type of trade that I would be looking at. Or let's take a look at a 112. And I'm also going to read your comments here because I see you've been typing away here. So I am enjoying my summer, by the way. I'm considering buying out of the money short calls and moving my puts out in time to get back some credits. Your thoughts, please, and thank you. On a working, so you're already in that trade. Yeah, so in that case, I mean, this is where it's just, right now it's short deltas. So if I was adjusting, I would be rolling up the puts. There's quite a bit of premium in Tesla as well. So what you can do is you can sometimes actually get paid to roll up and out. Let's take a look. If we were to buy that out, I didn't read that it was existing. I apologize for my lack of reading skills in this case. But if we were to buy out both of those and then roll up, I'm getting about $200 credit to roll to the 240. And the question really becomes, can I use some of that credit to roll out to a slightly neutral position? So in this case, it would cost me $15 to disregard this crazy chart here. But in this case, rolling up from the 230 to the 240 put, and then means that I would be able to roll from the 290 to the 305. And that would neutralize deltas for a cost of $15. So for the added safety of that is if I'm worried about the upside, that is one thing that I would consider doing, because really all I'm doing is putting $15 into the trade, but I'm giving myself another $10 of potential. Or I can run up the put even further, and I could actually get a credit to do that if I wanted. So I continue to move my puts up for credit. I mean, that's exactly what it is. I don't mind these positions. The other thing I can do if I'm worried about this is I'm assuming the credit was pretty decent to start with. You can always buy a call on the top side. What that would do is if the stock does continue to run up, then it just limits the loss. It softens the move on the upside. So that's another way that I kind of deal with it. It depends on how many contracts I have open. Like if I have multiple, then I would definitely buy some calls on some of them. And then if I had only one, then it's a bit of a different animal. But the delta adjustments are really kind of key in that case. There is 31 days left. I would expect that you're probably looking to close the trade at 21 days anyways. So you're only in it for another 10 days or so, 10 to 15 days with this lower volatility. And I think that kind of move, just adjusting the deltas is the smartest move in those cases. That's what I do. Anyways, Mike says thank you. I appreciate that. If you ever make it to your neck of the woods, if I ever make it to your neck of the woods, I owe you a beer. Well, that would be great. I love drinking beer. And let me know where you guys are. I mean, obviously, Mike, you're from Massachusetts. I've never been to Massachusetts, and it would be great to get down and travel around the States. I would love to do that kind of thing. Just get on the road and do some trading in person with people. I think that would be super fun. Bruce says, hey, Levi, would you be concerned about the gaps below current price with Tesla? Absolutely. Last week when we were looking at a butterfly on this stream, I was already concerned with a down move. When we see price moves like this, and you see what Bruce is asking about are these gaps here, this 240, 230. I definitely am. There's a lot of potential that Tesla could come crashing down. I mean, we are in a precarious situation right now. This interest rate, the Fed is really trying to crush the market. They gave pause to the interest rate hikes, but there is expectation they're going to see 2 more hikes by the end of the year. If inflation comes down, that could easily go away. Is that going to drive the market up? Yes, but it's only going to drive it up in certain stocks. There's a ton of stocks out there that are still massively down when we look at it from a kind of bigger perspective. I'm just trying to think about what other stocks that I might look at that you can say, well, that isn't looking nearly as good as I would like it to look. Stocks like Robinhood, which let me just move this over here so we can see this price. You can see Robinhood was trading at much higher valuations. What else? What have we seen that has really come down? Fiverr was an $85 stock. Now it's $28. eBay was 60 something dollars. Now 44. The DKNG is not on here right now. Chewy, another one that just down massively from its highs, $50 trading down at 40 just from January of this year. Apps, another one trading now at $9. Lots of this tech sector stuff, but this is a $50 stock now trading at $9, and the list goes on and on and on. I mean, you can just scroll down. Even stocks like Disney. Disney's trading at $90 right now. Disney was trading at $140 last March. So in just over a year and a half has had a massive down draw, and that is pretty extreme. Stocks like EA, this trade is actually, or this stock has actually been fairly flat. This is one of the ones that I have made quite a bit of money on this year, mostly because it's been fairly range bound. And whenever it's been around this 120 mark, I've been watching to pick up trades. So I've been kind of targeting this zone here, and it's been pretty good. Right now, I don't have an EA trade on because I don't want to bet to the downside in these particular stocks. I would rather wait for it to come down. And if it doesn't, then I don't worry about taking the trade. If we look at stocks like eBay, we're seeing, relatively flat-ish 200-day moving average now. So this is something that is happening after a large move to the downside. Are we going to see a consolidation channel? Are we going to see eBay trade in a range like this? And when you highlight it and start to look at it, you can see that it's actually fairly tight range. It's like, eBay trades between $40 and $50. And can we make money off of those trades? And some of these stocks, like if eBay, if we look at that, I'm pretty sure like a weekly Batman works extremely well in this case. So let's just go out 10 days and say, well, what can I do? Is there potential of making money if I do a fairly tight Batman trade? And so if you're looking for trade ideas that aren't condors, just being a little bit creative about stuff, this trade has a profit profile that is going to pop up off screen. I'll bring it down here, but it looks like a bat ears in here. It's got an 80% probability of profit. It only collects about $15 to open. So if it stays in the middle, it makes 15 bucks. But if it moves to either side, there's a potential of making up to another $50. So on a 10% move, which is quite dramatic, if the stock moves 10% of its value, it's going to be around 40 bucks. Then we do lose money on this trade, but you don't lose a ton. Like this is a $200 loss if the stock moves 10% up or down. If it only moves 5%, you actually make a pretty decent return on these trades, and very, very easy to convert these into a limited loss trade if you like. So as long as there's enough premium, or as long as there's enough option volume going on, then you can see that we can set up a trade that can work quite well. In this case, this is actually open for a debit, so although it would be very, very minimal, I wouldn't make any money if it stayed in the middle. But again, using complex options to adjust these trades can be quite lucrative. So I'm looking at this profit profile all the time. In this case, $23. And my total margin impact rate here is $1,700 Canadian. And I have the chance of making a little bit of money if the stock moves to one side or the other. And we can see our break evens on there, 42.63 to 46.87. So when we look at the chart, this is actually pretty decent range. Let's just mark those on there, 46.87 and 42.63. Where did the chart go? So let me just add a couple of lines in here, 46.83 and 42.60 and some change. So if we zoom in, like that's the profitable range for this. And with this little bonus, if it trades up near one side, so if it moves up into this range over the next week and moves down into this range over the next week, we get a nice little bonus profit. Otherwise, if it stays in between this, we get to collect just whatever the credit collected is, which in this case would actually be pretty decent. I mean, this is a $4,400 position, and the credit to open this is about 30 bucks. So this is a Batman, a 131 Batman. That's one of the types of things that I would be looking at, because this is how I build. This is how I build everything. I'm looking at the charts. I'm looking at my profit zones. I'm looking at my assumption. I'm looking at the delta, and I'm saying, okay, how does this all work together? Now, a trade like that is not as easy to adjust, but it gives us the choices that are very specific to our own assumption, which is the coolest thing about what we're able to do. And the software allows us to be able to set this up really, really easily. Todd says, many thanks. As usual, you're very welcome. Jacob, first time I've seen your sign red for a few weeks. Yeah, you know what? It is. It's down. I don't even know. It is. So for those of you who don't know, I do have my sign either red or green, depending on the day. It is red today. I am long the market, and S&P 500 right now is down. Let's just take a look. The S&P 500 is down 0.39%, and I believe I was down 0.1% when I started the stream. I closed off my brokerage. This is in my margin account. My longer term accounts don't have that much volatility in them. They're nearly flat on a day like today. What has happened? I have frozen something there. My longer term accounts, I have, with this run up, I have quite a few in the money covered calls that I'm dealing with. And so I haven't seen quite as much of an extreme move to the upside, but on a day like today, there's like almost no change because my calls have gone in the money. Looking, you know, I project on my larger accounts, I'm only looking to make about 15% annually. And that is enough for me to live on and for me to be able to sustain the amount of money that I have. So I choose to take a little bit less money to try to be able to have a consistent return. So if we look, like I never made a video about it, I feel kind of bad, but like if we look at my longer term accounts last year in 2022, I was actually zero on the year in one of my accounts, which although is not great, I don't want to be zero. The non-drawdown that I took was fantastic. Now moving into 2023, boy, I'm going reverse right now. Moving into 2023, I just looked yesterday and I'm only up about 5.5%, which is exactly on target. So I'm looking to make about 1% a month. So when I'm halfway through June, ideally I would be at about 6.5%. Over the course of the year, but I'm at 5.5%. So I'm slightly below my target, but considering the drawdown that I didn't have last year, this is overall working very, very well. And I use that, my strategy in those bigger accounts is just super simple. It's like I buy stock and then I sell very close to at the money calls. So I am collecting about 1% in extrinsic value, which means that oftentimes I have calls that are in the money. So I actually have a little bit of account protection. So if the market drops, I actually have pre-collected that money in cash. It's one of the ways that I deal with it. Then obviously, you know, we're trying to time the market a little bit and trying to get into new positions, and all the time I'm adding to those accounts anyways. So they just grow naturally over time. So I'm using very, very basic strategies to try to make that, you know, 15% annualized return. And I see that somebody had a retracted message. Mike, you can just type it again. I don't know. I'm not in control of that. That's YouTube. So, yeah. And Alejandro is watching from Monterrey, Mexico, another place I've never been, but I feel like I haven't traveled. I have traveled a bunch, but Tommy's watching from San Jose, and I always enjoy you guys telling me where you're watching from. Appreciate it. And when I do start traveling again, which I hope to, I plan on doing some events live, which would be pretty fun. Get together with you guys, have a beer, sit down and talk about different ways of trading. Does anybody have any specific other stocks they want to look at, or if they have any specific trades that they're trying to do? You know, I actually haven't put on very much this week at all. Yesterday, obviously, the market was closed. We're doing a little bit of futures trading. I'm still doing some crude oil has been one of my best trades this year. Been fantastic, just selling strangles on that. And then doing some slightly different setups for those types of underlyings. We've got a corn position on. So, you know, this year I definitely have been diversifying more than I have in the past. So I've been playing some of the currency exchanges with neutral trades. I've been playing futures like corn, oil, things like that. And what else have I been doing? Yeah. Mike says, I like running Batman, but the commissions and fees add up quickly, unfortunately. Yes, they do. And one of the other problems with Batman, yeah, sure, Batgirls, Batwomen, whatever we want to call them. One of the other problems is the margin requirement. I mean, sometimes those, if we're doing limited loss ones, I know with IBKR, they charge me margin on both sides. So I have to take that into consideration, that my margin requirement is often much greater than the amount that I'm actually risking. So that's an unfortunate thing about it. And definitely the fees do add up. If you're doing volume trading, then obviously those fees become quite a bit less. So it really depends on how big they are. And the other thing is there's a tiny bit of slippage with those. When you have multiple contracts, you're not getting quite as good of fills as you would if you were doing something that was less complex. But it is something we have to take into consideration, that extra margin, extra fees, and extra slippage. Mike, another question for you. Can you quickly go over your in-the-money covered call strategy? I know you mentioned it. It's a trade only you have to babysit monthly. Yeah, one of the trades that I look at, I can absolutely show you. One of the super basic ones is on SPLG. And the reason I like to use SPLG is because it's an S&P 500 stock, but the reason that I like to use it is because it's such a low price point. I mean, for $5,000 positions, it is extremely inexpensive to get into. So if we were looking out in July, what would be the amount of money that would be getting us, or what covered call would be getting us 1% return? And all we have to do is just look at the purchasing it today. So if we were to buy into this position today, it would be a debit to open. So 5,000, we're going to call it $30 to open. And the profit profile on this is going to be, let me get this open. Here we go. You can see here that this trade will make about $65. And as a maximum. Now, the easy thing to do is to look at it from the perspective of how much am I in, how much am I out, and is that 1%? So in this case, what I do is I run this math. I look at this and say the debit to enter is going to be $5,030. If the stock stays above 51, which it currently is, it's currently 51.44. If it was to stay above that value, I would get 5,100 at the end of the month. So over that 30-day period, does that work out to 1%? And here's the math on it. So we have 5,100 would be the amount of credit to close this trade. We subtract the amount that we have initially invested, which is $5,030, and we're left with a profit of $70. We divide that by the amount that is initially invested, which is $5,030. And we get 1.39% return. We divide this by the number of days. In this case, that's 31 days. And we times this by 365 to give us the annualized simple return. So if we were to do this trade every single day for the rest of the year, this in the money trade, and if it was profitable every time, would return a 16.38% return. So that's kind of the simple setup on it. Now, unfortunately, right now, the VIX is low. So we're trading this 51 call, which is very close to at the money. I mean, the SPLG is trading at 51.44 right now. So if we were to see any sort of dip, then there's a bit of risk in the market. But for longer term portfolios, doing this over time, I have found that this works extremely well for that, 1% annual or 1% per month, which works out to about 14% compounded over time. When the volatility is higher, I can sell those strikes much, much lower and have more safety in my account. So I get greater safety when there is fear in the market. Unfortunately, there are some drawdowns, but that extra bit of premium can help quite a bit. So that is a strategy really that kind of helped me last year. There's one of the positions that I had on that was able to kind of soften the blow in my account as the market went down. Now, the other thing I was doing was I was letting some of those positions get called away and going back to cash and saying, okay, well, as the market is coming down, can I kind of wait and time that market and get into it? And I was able to do that fairly successfully last year a little bit. So my patrons know, I mean, it's I'm going to push a button that's not going to work today. But if you guys are interested in signing up for Patreon, I mean, that's one of the ways that you can see exactly what I'm doing, because I post all of my trades in my Discord account. So if you head over to patreon.com/drawbridgefinance, actually, it's pretty cool. I updated the graphics recently. So there's going to be a change to the format on Patreon starting on June 30th. So in 10 days. So I had to do some more Photoshop stuff and get some of the graphics updated, which was kind of fun. I also made a post on Instagram over the weekend with some of the AI artwork that I've been working on, because I went to art school. I was in the art field for a very long time working in movies. So that kind of artistic stuff is fun. I love the numbers and I love making money off of being able to be at home and be flexible. But I also have a lot of interest in art in general. And so I'm kind of toying with the idea of kind of putting those graphics a little bit more and making my stuff a little more playful, which is fun, because it's this stuff is just numbers, and it's fun to have something fun to look at. Mary James, hi Levi, great information. FGen, July 21st, bull put the 10.5. Okay. FGen. That sounds great. Let's take a look at it. I'm going to pull up, actually, you know what? I'm going to pull up something slightly different here because I don't usually trade FGen. So just bear with me for 1 second. And let's see if it's going to pull up here. Just signing into Options AI. So here we go. FGen. I don't know anything about this company. So I am looking at it right with you. I'm going to look at the expected moves over the next 3 months. Pretty wide. July 21st, the expected move is 63%. Now, one of the things that I like about using Options AI is that I can see the data based off the real options chain. So this is a visual way for us to look at it. It's slightly different than looking at it in IBKR, but we're taking that real-time data and they extrapolate it for us, and it shows us the expected move in this nice charting way. So we can say, well, here's the expected move, $6.14. When I look at stuff like that, I have to dive deeper into the stock because this is a pretty wide range. I mean, the expectation is the stock's going to be trading somewhere between $6 and $27.50. So this tells me that something is happening with this company. Let's take a look at the FGen. There's got to be some sort of announcement coming up. I'm just going to look back at the past history just to see what we're looking at. So in the last while, $10, $25 has been the move. So pretty wide range. I'm going to go back a little bit further. I don't know anything about this company, so I just want to see where it was. Wow, okay, so $65, and now we're in a downtrend. So blindly looking at this, my assumption is that there's some sort of announcement coming up and that there's something massive going to happen. So let's look at how much credit we can get for that spread on FGen and see what you're looking at. So selling the 10 put, we're just going to do it very, very straightforward. Just going to turn on all. Just a very straightforward bull put spread. The risk on this is about 2 to 1. So because we're collecting so much credit on the open, gives us a nice low break even of 7.89. I mean, this is an extremely lucrative position. The problem with these, of course, is, and I've traded these before. In fact, I just had one. We had a trade like this. We looked at an alternate setup. If the stock was going to be trading around, $7 or so, a very, very similar setup. The stock was trading about $15. The assumption was it was going to stay above 10. There was an announcement coming. I actually set up a trade that had almost no risk on it. It was like, would make a ton of money if the stock dropped to $7, but the break even was closer to $5. So I did a put ratio spread on it. In the end, the stock went to 0. So I ended up losing the $500 in risk rather than making the $500 that I would have wanted to make or would have been able to make had the stock dropped to $7.50. These companies can do that. Whenever we're looking at anything that has pharmaceutical in it, whatever biological research, they tend to cost a lot of money. So when they have products in development and when they do a release, the stock can move either way. So I certainly don't play these very big when I do play them, but I oftentimes add a huge amount of downside protection if I can. So and I don't know anything about this company, so I'm just going to say that as a caveat. Obviously, very nice risk to reward because this is a $5 spread, and it's because it's being open for a credit of about $2. And even if you filled it at $2.10, you've got about $290 in risk to about $210 potential profit as long as the stock stays above $10. Now, what I might be tempted to do if I was getting $2 on this is I might put on some other trade that's going to make some money as well. Like this. If I can do a $2.50 wide spread, now I've created a trade that doesn't make any money if it goes up. Well, it makes some, it just doesn't make very much. I would have to pay $250 to get out of this call spread if the stock went up, leaving me with a profit of $40. But this would increase my potential credit because my potential profit, and lower my break even down to 709. So there's one way to do it. That's one consideration. The other consideration is, I mean, obviously, if I wanted some upside, if I thought that the stock was going to move up, you can even do it pretty easily just by adding that call on the top side. Whatever money is generated from this, as long as the spread is less, let's just go to 100% move on this and see. Basically, if the stock stays anywhere in this range, I'm now making $225. So, and if it blew up past 35, I would have to pay back the money. So I wouldn't make any money if it went up above 35, but I would have a lower break even. And as long as I was collecting more than $2.50 to open this trade. So that is something that I might consider. The other thing to do is, or to consider, is to swap these, do a buy, and let's just, I wouldn't do the calls in this case because I'm not going to get enough credit to open. But if I was worried about downside and I wanted a trade that was really likely to make money, then I could do a trade like this. Again, it doesn't make very much money. Now the break even is $4.95. So if I was very confident, I would do that bull put spread, and I would add the upper call spread, and then collect a nice credit, hope that it stays in that range, which is the expected anyways. This trade would, this would be if I was worried about downside, because if it dropped down to 750, which it could easily, I could actually make a substantial amount of money. I could make $200. If I was considering multiple contracts on something like this, this is where I would mix it up. I might do like one ratio spread and then one just bull put spread. Another thing that might work in there is a butterfly. So let's just take a look at what that looks like. Just thinking, thinking about these moves. 132 butterfly. So what's my max loss? Is $215, break even 607. So a $200 risk, and I could make up to $285, and I've got an 85% chance of making money. And this is the trade that I would take. I mean, for risking the most that this would cost me to get out of this is 500 minus the 250. So it cost me 250 to get out, and I'm collecting a credit of around $50. So that is the trade setup that I like. Basically 85% probability of profit as long as the stock stays above 607. If the stock does go down to 750, really nice little bonus on there, and max loss of about $200. So yeah, that's the way I would do it, because that is a highly probable trade, which is the fun thing about doing this. Why is that? Makes me wonder. I wonder if this button isn't working because I didn't have my Atem software open. Okay, let's look at some other position. Jeff Haas says, careful with these biotechs. Yeah, I agree. They can just go to zero. I mean, that's as easy as they go. Jacob Carlisle, ask an opinion on an open trade I have. It's on AU. Sold to July MQG 174 puts for $750 last month. Yesterday bought the July MQG 170 put for 38 cents. FGen has trial data. Thanks, Jeff, for chiming in there. FGen has trial data coming out soon. I mean, these are normal things for these types of companies. Whenever we're looking at biotech or even pharmaceutical, both biotechnology and pharmaceutical, they both operate in the same thing. When you When you make money on them, it's great. You make money. When you lose money, it sucks because you've lost money. You know, there's high risk, but then high reward as well. So you just have to be careful with it. I wish you guys the best of luck whenever you're playing them. I've had some success with both. You know, I've lost some, I've made some. So let's look at sold 2 of the MQG 174 puts for $7.50 and then bought the MQG 170 put for 38 cents. I mean, that sounds like you're in an amazing position. No, it's still not going to work. I was just trying out with my other software open. MQG. Macquarie. Is this Macquarie on the ASX? Must be. Sold 2 of the July. So I'm not going to have any data here. I don't know what's, I don't know if I'm looking at the wrong thing here. What I'm looking at is not giving me proper data. Not getting proper data, but this is the time where we get to look at my rolling options record keeper, because then we can see how this functions for this exact situation. So if I'm going to open up a new trade here. I'm going to, give me one moment here. I'm going to just pop this over so you guys can see what's going on and close this. Bear with me for 1 second, because this is like exactly the type of thing that this, how this works great. I would love to know what price this was trading at when you opened it, but it's kind of irrelevant. So I've opened up a new sheet and I'm just going to put in Macquarie's information here. So I'm going to type in, it's not going to be able to pull up the stock price because it's on the Aussie exchange. And I'm pretty sure I can't. MQG. Let me type this correctly. ASX. No, it's not going to pull that up. But let's just say that this happened last week. So June 14th, the underlying price at that time was going to be, what is it right now? We're looking at it with 185. Let's just say it's at 185. And what sold 2 puts, right? So we started with naked puts. And we had an expiration of the 21st. And these were the 174 puts. So in this case, this is how I'm going to do it. I'm going to do it like this because I know that I'm going to make an adjustment. So I'm going to show you custom here. I've done 2 short puts and I've done a total credit of $15. So one of those. What I've done with this is I've sold one for $750, sold a second one for $750. I've added the credits together. I've collected $1,500 and I have done this in, we're just going to call it US dollars. We can do it in Aussie dollars if we want. But what this does is it shows us a profit profile. Basically, as long as the stock stays above, we're going to be able to close this for $1,500, which is what we collected. Now there's been an adjustment. So the expiration date stays the same. We're still at the 21st, but what we've done is we've turned it into some sort of put ratio spread. So we should be able to, if I just type this in, put ratio spread, we still have the 174 puts on, and we now have a long put of 170 and for 38 cents. So we made an adjustment of 0.38 cents. And we're going to, that's going to be today's date, 185. As long as I fill in all the information, this should calculate out. This is not liking this because the put ratio requires that the long put be higher than the short puts. So I'm going to change this back to custom, and that allows me to put in any data that I want. So the First trade that I made collected 1,500 bucks. Then I sold or purchased the 170 put and for 38 cents. So my net credit, the premium collected to date, which is row 29 on my sheet. This is the most important row. Is that correct information? And the information is saying that I have collected 1462 from 1,500, which was 750 times 2, and then minus the 38. I've collected 1462. So you can see how much the risk reduction has been. The amount of money that I can potentially make on this trade is still very, very similar, 1462, but because this 170 put was purchased, there is now considerably less risk. If the stock was to drop to 160, this trade only loses 338 bucks comparatively to the previous trade, which would have lost 1,300. So almost $1,000 difference. And we can graphically see how that changes with the adjustment that's been added. Now, in this case, with the cost of this, I would have been considering putting in 2 of these and doing this for a net 38, what is that, 76 cents, right? So negative 76 cents. What that would have done was made this a zero loss trade. I can adjust this down and I've collected, potential 1424. And now, even if it drops down, I still make 600 bucks. So completely removed all of my risk after this move. My assumption is, without looking at that chart, is that the stock was not trading at 185 when this was placed, selling these 174s. The stock must have been much, much lower to get $7.50 credit. And so we've seen a move to the upside. Let's go take a look at what has happened over the last, so let's just look at these daily candles. Yeah, so you entered this last week. I mean, you just caught the move. I mean, selling the put at that time, right at the money, or whenever you did this, maybe even in the money, collecting $7.50. This for 38 bucks, you can basically lock in all of that potential profit, or you can just close the trade depending. I mean, I don't know what the current price is right now, but with this move from 175 to 186, most of that has already happened. So the selling a put is the bullish trade. The bullish move happened. There's 2 ways to reduce your risk: either buy a lower put, or just close the trade and say, well, that was a great trade. Congrats, by the way. That's amazing that you got that much money off of that. So fantastic move. And you did it last month. So good job. Manila Madness. FDX has earnings after the close. I'm not really interested in trading it, but just for learning purposes, just wondering how you would play around with it. Okay, that is a great question. Sorry, I'm having button problems today. Let me zip over to, this is another little thing for Options AI, because looking at FDX, which is FedEx, we're going to see the expected move. And this is the fun thing about Options AI. It's one of the reasons why I'm an affiliate of theirs. If you guys are interested in the discount, while that loads, there is a discount code. You have to kind of put the code in near the end of the application process. So when you've signed up for your trial period, at the end of the Stripe setup, there is a place to put in a promo code, and you can use all caps drawbridge. That way you get a discount. I get a little kickback. I love their service. It is fantastic for this type of reason. And why is this? I say that, I hype it all up, and then now it's just going to sit here and calculate the expected move here and not give me the data that I want. I don't know what's going on. I'm just looking here at my, there we go. I was just looking at my internet connection to make sure that everything was going well. Sometimes it's a little slow when I stream, but stocks trading at 431, expected move is 5.7%. So looking at the 244, 218 move. And what would you play if I wanted to take a neutral trade on this? Oftentimes what I do is I will trade very, very short when it's earning. So in this case, an Iron Condor, risking 350 bucks to potentially make 150, 71% probability of profit. Again, another reason why I love Options AI. This just pulls up these positions. So if the stock stays in range, I can make a very decent amount of money. Iron Butterfly, you know, we can do the same sort of thing. We can just scroll back. We can do a little trade. Max potential on this is 1200. On butterflies, of course, this is not very realistic to be looking at this. What we're really looking at is our max risk and where it is, where it falls on the graph. And this is why I like using options AI, so we can see the expected move. Now, the other thing we can do is we can click on the little earnings tab down here. So I'm just gonna get off this trading one. We're just gonna go to the main page here for FedEx. And if we just click on earnings, it will tell us that it's Tuesday, June 20th, which is today. There's the expected move, 5.7%. And we can also see the last moves. So we can see that the last couple of times, March 16th being the most recent, was a negative or a positive 4.48% return. Time before that was positive 3.43. September was negative 3.37, and last June was 6.62%. So we actually had a fairly large move to the upside last June, and then the stock pulled back into range. In September, we saw that move and then stayed flat after the move. We saw a little bit of creep up in March and relatively flat. Looking at this, I might consider looking at what happens after the announcement. I might consider doing a slightly longer condor. So looking at a condor that is 2 weeks out. Max risk $335, max gain 165. So you're looking at about a 50% return on capital, 68% probability of profit, and pretty wide range. So we've got the 215, 210 puts on this side, and then the 250, 255 put calls on the top side. And let's do one more thing. Let's just look back. You can see why I like options AI, because it charts it right on there. It's pretty cool. Let's just look at FedEx, which I don't think is on my list. And thanks for bringing up this question, by the way. So FedEx, yeah, so 51% IVR. And the other thing I like to look at is just where these strikes might be relative to what it's been trading. I mean, it obviously had this massive move. This was in September? Where's TradingView? Let me just look on TradingView, because I just want to see where the earnings were. FedEx. I'll scroll back here a little bit. We've got earnings. Oh, I must be on the 1 minute. So we saw earnings. We saw earnings here. Boy, that seemed like a big gap. 190. What were the strikes? Just looking at this support here, the 190. And this is on the put side, 215, 210. You know, this is a hard one. Then this is why earnings, my experience with earnings is I make just as much as I lose. They're fun to trade, but there's like, oh, I made some money on that trade and then I lost. And because there's only 50% return on capital, that means that I'm taking 100% loss sometimes. And it takes me 2 winning trades to match 1 losing trade. So these moves can work for us and they can move against us. Looking at that, I probably would be trying to get a little bit lower, even with that 5.7% potential move from options AI. I would be looking at this 200 level to see if I could set something up. Where is? And I like this. This is how I might play this. I'm just going to go through here. Take a little bit smaller credit. If I could get this for $1, then I'm making a 20% return on capital. And I have a 76% chance of making money. Break evens between 199 250. And this is where I have to chart them myself, which is the nice thing about options AI is that it shows right on there. but there's the 200, 250 break evens. And obviously we saw the stock trade lower than that in the past, in which case, you know, you're taking max loss. But for a 20% return on capital, I like this trade quite a bit. And that's well outside of that expected move that we're seeing. So it's the same top side, the 250, 255 calls, and the just lower condor on the downside, just giving myself a little bit more room if it decides to pull back, which it could easily. I mean, who knows what this guidance is going to be like in this earnings session. It's just there's lots of stocks that are not performing super well. The economy is not super strong. Are we going to be in a recession? Are we not going to be in a recession? There's all these questions in the way. If I was trading FTX, that's how I would trade it, with that 195, 200, 250, 255 for a $1 credit. B-Baller. Hey, Lee, thinking of doing a short strangle on NVIDIA. What strikes would be good for something 50 to 60 days out? Boy, NVIDIA is just on an absolute tear right now. I am so glad that I didn't play strangles on it, because I recently had all my shares called away from me. But with this AI, they've just been pushing up 434. And last week we looked at like a 470 call spread. Who knows? Like, is this stock going to go over $600? I would be feeling pretty silly if I was losing money to the top side. So if I was considering this, and because I've been in the position before on positions like this where stuff is going up, if there's any short interest at all, there could be a potential short squeeze happening after we've seen a move like this, which we know what happened with stocks like GameStop. I would be trading it with like a Jade Lizard setup. That's how I would do it. So let's take a look, or I would at least do some sort of diagonal to the upside. So let's look at NVIDIA, and NVIDIA should be on my list here. So we're looking at the VIX is super low, so we should be closer to 60 days. And we always go, just a kind of general rule of thumb, the lower the VIX, the longer the time. The higher the VIX, the shorter the time. That's kind of one of the things that I like to do. Obviously, we're collecting quite a bit of money for these strangles. There's a lot of risk to the downside. Collecting $6 or $5 on this position is pretty great. This is where I would be not taking any upside risk at all. And I'm saying, instead of doing a strangle, I would look to collect some credit. You can do it. I mean, you can get credit for anything here. Looking at 550. I mean, it seems crazy. How much money am I getting for this? This is adding not very much. So in this case, what I might do, because I'm going to do it as a spread to the top side, I might go way more aggressive with this and sell like the 30 delta. So if there is a pullback, say the 475, 480. Now I'm collecting enough money. So if the market goes up, then I'm still going to make some money, because I've created a position that's only going to cost me $500 to get out of on the top side, which means that even if it goes up, I don't make very much money, but I still make some. If I could get into this trade for 660, then I would make $160 profit if the stock went above 480, because I would have to give back 500 of the 660 that I collected, and I would be left with $660. If it stayed in the range between 360 and 475, which is $115 wide range, then I make $635, or 660 is what I would collect to open this. And so $660 profit. And then the downside would be, of course, if the stock went down to 355. And that would be where my concern is. I would be concerned on both sides, especially with this large gap. I mean, 353 is right in this range here. the stock has moved a huge amount. I mean, I just had my shares called away from me for $205. So I was thinking that I had done pretty all right, selling them at this level. Who knew that we were going to have this move to the upside? I mean, if I could have predicted that, I would have not been selling calls against my shares. And luckily I had no upside risk. So I was sitting pretty, taking a profit on that move, but not as big a profit as I could have made had I just had the shares outright. So from these levels, there is talk that it could be over 600. I still would not be betting against it just because of the type of setup. I don't like to bet against the trend in these situations because it seems like it could be a good idea. And when it turns out to not be a good idea, you're just kicking yourself. You're saying, well, we could see the trend. We saw what was happening. We know that there could be some short interest in there. Actually makes me wonder just what the rating here is on. I'm just going to pull up Seeking Alpha here so we can take a look at it together. But the valuation right now is an F, which would lead us to be betting against the stock. We think that the stock is going to come down, but the growth is huge. Profitability is huge. The momentum is massive. And what I would be interested in here is the short interest, which there seems to be none of, only 1% people shorting it. So everybody's bullish on this stock. And again, this is also why I wouldn't be necessarily betting against it. Is it a great time to buy? Not really. I think that this is where like a bear trap setup might be a much better setup if I was looking to go long. But I mean, there's tons of premium in there. Absolutely selling the strangle. Yeah, I mean, I shouldn't just disregard your question altogether. That's just me. But looking at this, how much money can we get? 475. Selling a 16 delta, 13 delta. Sorry, what are we looking at? 12 delta. I mean, 580. You're still getting paid $400 for selling the 580. This has got an 85% chance of making money. The max profit range is between 360 and 580, so $220 wide. It is pretty big. So the downside break even now is 350 on this, and the upside is 589. So pretty massive move that would have to happen, but that move could potentially happen. So collects $940, and this can be tightened to adjust deltas. Really, with this kind of stuff, when there's this much premium in it, collecting $400 on a $580 position, the 10 delta, I wouldn't want to go lower than 10, but any of the strikes between 30, so 490 down to 580 are acceptable, and then are within the range where we're getting paid the risk for the risk. And then 355 is 10 delta. In this case, there's so much downside risk that the 345, which is only an 8 delta, still pays 1% over a 60-day period or 6% annually. So there's a fairly low risk trade by just selling and collecting $400 there. But again, could trade up as tight as the 30 delta. So anywhere between 360 and 405 would be the strikes that I would potentially choose on the put side. This gives us a massive amount of credit, obviously, and allows us to directionally adjust this. With strangles in general, I do like to adjust them neutral. So I've done videos on that before, converting a strangle into a straddle, and when you've got time to do it, they can work very, very well. NVIDIA is a tough one right now. I'm actually not touching it at all. There's that large gap below. There's lots of momentum. I don't know where it's going to go. I'm just going to let it play out for a bit. And we're going to see what happens, but I don't want to get caught in something. Yeah, that's just me. I'm a fairly conservative trader. Jacob Carlisle, wow, you are so generous with your explanations on this free stream. Bought 6 puts on that MQG trade. Wow. Good. Well, that's awesome. Yeah, no, I mean, this is what I'm doing. Like this took me a long time to learn all of the strategies that I employ. It's like, I love talking about this. I mean, I get emails from people all the time and we get to chat about it. My biggest kind of gripe about the internet in general is when people either have information that they're not willing to share. It's like, if you have that knowledge, there is nothing better than being able to share it with somebody else. And the other thing that I just really gets under my skin is when people they just blanket statements say that options are risky. I mean, I like to think that anything that we invest in, including with our time, there's a risk to it. I mean, I take personal risks by coming out and doing this type of stream, but the reward that I get for being able to communicate with people and being able to have conversations about building wealth in general has just given my life so much meaning and like purpose. It's like, it excites me that I'm able to share what I have learned. I spend way too much time doing this stuff. I mean, I love it, but I have spent a lot of time in my life doing it. So this is a way for me to like give back and hopefully kind of share that knowledge with you guys and be able to just say, hey, like, let's look at this stuff together and let's look collectively at where we can potentially make money. Because at the end of the day, this helps improve everybody's lives if we can make a little bit more money off of our investment returns. And that's really the goal for me, is to try to teach people and try to put it in simple terms, what I have learned and what I have found has worked quite well for me. So that's kind of, my personal thing of why I do this. And it's fun. I love it. So thank you guys. You guys are so great. It is 12:20. I've gone way over time today, and I would be pushing the button that says let's get rich together, but my stream buttons aren't working today. I'll get that sorted out for the next time. You guys are fantastic. Thank you so much. Let's get rich together. Take care.